welcome to our final Quantacast of the year, which makes 5 for us. We've had a great response actually to the Quantacast so far. I think we've had over 1,000 views in total. I'm not saying for everyone, Chris, don't get excited. A lot's happened this year, so we're really excited to wrap up things today. Chris is going to talk to us a little bit about what we've transacted over the last 6 months, what's going to come for us in the coming 6 months for our investors. Stacey's going to touch on a few things that have happened around the office, and also we'll have a couple of guests on throughout the Quantacast, so it's jam-packed today. Firstly, one of our 2 guests is on my right, and that's Chris Ball. Chris is an international tax and corporate tax specialist. He's a partner currently at BDO and has been a partner at other firms across 25 years. He's a very trusted advisor to Stacey and the Quanta business, and has been for many years. He's probably far more intelligent than the 2 of us, Chris, but we'll test that today. He's here to talk about some tax advantages for our investors. So welcome, Chris. It's nice to have you here.
Thanks for having me.
Now, because Chris Carrigan's a bit of a tax nerd, I thought that he might be able to fire a few things off at you to get the conversation started. So over to you, Chris.
Yeah, look, I thanks for that flattering description, Tim. But tax is obviously an important part of investing, and coming up with an advantageous tax strategy is important. One thing we do here is, as the investment manager, is focus on things like tax deferred income and how that affects capital gains tax. But Chris Ball has a lot more horsepower in this area than me, and I thought it'd be great if Chris could explain the concept and why it's important.
No problem. So I think the 2 things that most investors will focus on is the tax-deferred nature of investments, and we'll have a little bit talk about that, but also the capital gains tax advantages and the capital gains tax discount on exit. But just to build a little platform to be able to explain those things. Firstly, there's a difference between how you're assessed on a distribution from a trust and on a dividend from a company. The first difference is that trust distribution, the income is taxable in the year that it was derived by the trust, whereas a dividend from a company, the dividend is assessable when you actually receive the dividend. So there's a material difference. The second difference is that with a REIT investment, there's a number of deductions that the trust is able to access for both depreciation of plant and equipment and also depreciation on the building, which is called capital allowance. And what that means is that a significant amount of the cash that you receive in your distribution is sheltered from tax, and that's called tax deferred. So there's a taxable component and a tax deferred component. And the newer the building or the newer the fit outs, the higher the tax deferred component is going to be because of those deductions that are available. What happens though with tax deferred income is that it reduces the cost base of your investment. So the reason the word deferred is used is that it reduces the cost base of the units that you have, which increases the potential capital gains tax liability on exit. But it's still a material advantage in being able to receive monies which are not taxable up front. The capital gains tax discount applies where a property is held for more than 12 months, which will be in all your investments, and only half the amount of the ultimate gain that's made is subject to tax. But in calculating that amount which is subject to tax, the tax deferred amounts reduce the cost, which is why it's called tax deferred. So you're paying at an individual only 50% of the gain that you've made you pay tax on, and with a super fund 2/3 if that super fund is in its accumulation phase, and once it goes into pension phase, of course, the gain is tax-free.
Mm. Okay, so it might sound like a silly question, Chris. So when we go through the acquisition of an asset, is it the depreciation schedule that we look at quite closely on? Does that have a material impact?
Yeah, that's right. So on any acquisition, there will be an allocation of the purchase price across plant and equipment, and also an inherited deduction for the building depreciation based on what the original cost of the building was. And by law, the seller is required to provide that to us.
Yes.
So we're able to model what those future deductions are going to be, and we have a pretty fair idea what the tax deferred components of those distributions are going to be. And in some cases, it could be 100%.
Right. Okay.
And so it also varies from investment to investment, the degree to which you can have tax deferred income. For example, we have invested recently in a building in Ann Street, which is the Quanta Ann Street Trust. It's got just finished an $8 million refurbishment, and over the next 3 months we're spending a very significant amount doing landlord works and fit out for a tenant to take 40% of the building. So that's going to be a substantial amount of capital works in the first year of the investment. So that is something that would give a high level of tax-deferred income.
Yeah, that's right, because the majority of that expenditure, or a lot of that expenditure, is going to be on plant and equipment, which is going to have a pretty healthy depreciation rate. So over those first 3 or 4 years, you're going to have a really significant amount of tax-deferred income, depending on the level of write-off that's there. But it's going to be significant.
Yes. And then for upon sale, 3-5 years down the track, our cost base is going to be, for the calculation of that capital gains tax, is going to be lower, but the prior advantages you've received offset the additional capital gains tax?
Yeah, that's right. Although they're at a lower rate too, because the capital gains tax that you're going to pay, you're going to get the capital gains tax deductions for, discounts for, so they're more beneficial. But what investors have to do is keep a record of those tax-deferred amounts. So when they get their capital back from the trust, let's assume that someone invests $100 yes. and the tax-deferred amounts that they've received were $40. Yes. Right? What that means is that their cost base is $60 against the $100 when they get their capital back. So there's an additional capital gain of $40 in that circumstance. But they need to maintain records of that. Yeah. Right, so they know what that tax-deferred amount was. But that additional $40, which is taxable, of course, will attract the CGT discount. So, yes. So it's still quite beneficial.
Yes. And Chris, knowing the business so well, because you've been involved with Stacey for a long time, is there any other advantages that you see from people investing in unlisted retail investment trusts like us?
Well, there's a core decision to be made as to whether the super funds are used, because obviously the super fund tax rate at 15% during the accumulation phase is very attractive, and in a pension phase, the tax rate's 0.
Yep.
And so one particular strategy is that during the accumulation phase, you're receiving the tax-deferred income, move into a pension phase, and then when the ultimate gain is made, even though the tax-deferred income reduces the cost base, because you're in pension phase, there's no tax to pay. So actually tax-deferred becomes a total tax exemption. So there are various strategies, and it'll depend on individual to individual how they want to invest their superannuation, but it's certainly something that their advisors would consider when they're looking at a unlisted REIT.
Chris, we really appreciate you taking the time to come in to see us today, and that's some invaluable information for both Chris and I and our investors. So thanks again.
My pleasure.
Thanks, Chris.
Good to see you.
Chris, we're pleased to have Dave Carpenter, our Head of Investor Relations, join us now. Dave's been with the business for over 8 years, I think, now. We can't quite get rid of him, but he does a terrific job with our investors. He would have spoken to all of them, if not very close to that. Been a very great worker and soldier at the business, and we're really lucky to have him. So, welcome to your first Quantacast, Dave.
Thank you, Tim. Chris.
Welcome, Dave.
It's pretty scary, isn't it, Chris?
It is.
You'll be absolutely fine. Dave, we wanted to have you on a few times. Last time we wanted to have you on, you were unwell, but you've had a huge year. You've had plenty of big years with the business, but it's been a really, really interesting year for you because you've watched a transition of new investors come in. You've seen some of our older investors that might not have invested for a little while come back into the fold and get stuck into some of the recent transactions we've had. So tell us a little bit about the sentiment over the last 6 months in particular, and what you've been up to get those investors engaged and happy with what we're doing here.
Yeah, absolutely. Yeah, it's certainly been a big transition over the last 6 months, 6 to 12 months. Talking to as many investors as we can, myself and Stacey, she mentioned earlier. I've been talking to a number of them, trying to see what makes them tick, so to speak.
Yes.
And then having 3 offerings in the last 6 months, and there's certainly been some good sentiment from our investors. A lot of the time we've been speaking to them, trying to find out what would be a good product for them. Closed-ended funds.
Been popular. Yep.
Very popular. Sort of liquidity is one of the key factors in the decision-making process at this point in time. So we've taken that on board. So closed-ended funds, 7 years life cycle for those trusts.
Yep.
For the Ann Street Trust, for example, we have a horizon of 3 to 5 years. We feel be able to extrapolate the value from that trust and return it to investors. So, yeah, I think that's been one of the positive things.
You've also increased the reporting for the investors, which I understand has been really popular. You know, the portal's really kind of feels like people have found their feet with the portal now. It's really good. Everything seems to be at your fingertips on the portal. So how have what's the feedback been on those two things?
Yeah, certainly. The investor reporting's been well received. So on a quarterly basis, we're providing investor snapshot reports, a little bit of an overview on the past 3 months, top tenants, sector analysis, what the more poignant things are with regards to leasing, values, unit pricing, all the things that sort of are the building blocks of those trusts. So we've had some really good feedback on that. We've got a good team in-house that have helped stylise that in the Quanta way, which has been an important part of it as well, with the rebrand from earlier on in the year. And that's sort of fed on to the investor portal. So most investors will be aware that throughout the year we've introduced a new system for investors. It's been well received on the most part. Which is fantastic.
There's a security feature there, Dave, on that as well, that I know that had a few teething issues around the authentication of pulling information from that data. But as we've seen with Medibank and Optus, and it seems to be occurring more, as much as that is something that our investors have had to adjust to, you kind of see now why we were implementing it.
Yeah, certainly. I think in the past we've always sent distribution statements, for example, by email as a PDF statement. Things have gone automatically to accountants, end of financial year for tax statements, financial statements and the like. We've followed the big banks, early doors into an online portal scenario for security more than anything. It's the one thing that we take most seriously is the information of our investors. You have to secure it. Emails can be intercepted left, right and centre these days. We've seen, as you say, with Medibank and Optus, and it seems to be every other day now that someone's had a breach of data by adding all the information into a one-stop shop portal. It's at the fingertips of the investors. We've got two-factor authentication, which can be activated for that additional level as well. So yeah, it's been a big transition into that. I think for some investors, it took a while to get used to it, but the team here are well used to updating those records for investors when they need it.
Good. Now Dave said data. Now we might say data, but Dave is an Englishman, and Dave's world started with the business in the data, and I think you've got something to share with us there, Dave, potentially as well. So I know Chris might want to chime in here. So since 1st of July this year, what have we transacted, mate, and where's the new investment come from? And do you want to just sort of fire off a few things, because I think they're quite interesting to note as well?
Yeah, I've got some of the details in front of me here. So 3 transactions, of course. The Multi-Sector Income Trust was the first one for the Manto Village asset, settled in July, purchased for 21.1 million. We raised 9.9 million of equity for that investment, and we had about 42% of those investors were new investors to us, which is very good. Fast forward to September for the Ann Street Trust, purchase of 39 with the uplift of 59 valuation on completion, which is fantastic. We raised just over 24 million there and had about 29 new investors. So again, 27% of those investors were new to us, which is fantastic. And then Launceston in November. So that was a 13.5 million purchase price, as you mentioned earlier. Just over 7 million of equity raised there. And again, another 22% new investors there. So, throughout those 3 transactions, we've raised over 41.7 million in equity, which is fantastic. And that has been a mix of existing and new, of course. So we have 56 new investors on the books, so just shy of 30% of those investors are new to us, and we hope to take them on the journey for the next opportunities that we have.
Fantastic. So when we throw in some disposals that we've completed as well, Chris, and I think we've got some things that are becoming unconditional in terms of what we're selling, well up over sort of about 125 million for the last 6 months. How does that sit with you? Are you pleased with that?
Yeah, I think in the current market there's a great opportunity to both buy assets and create new investment opportunities, but also recycle capital out of some older assets into new investments. So I think it's a really good time for us to make hay while the sun shines, as the saying goes. So I think it's an important time for us to sort of recognise the opportunity and do as much as we're able to, while still maintaining the discipline on pricing and investment fundamentals, but not leave any stone unturned.
Dave, the investors have, as we said, responded really well. The support's been fantastic, and we do really appreciate that. The reason I think is the personal touch which Stacey mentioned before. We've done a number of things around having our investors on site, a number of lunches all the way sort of on up the East Coast. So we've probably held 6 to 8 smaller lunches where we've got 15 or 20 people. We've got a few more coming up in the next few weeks as well. And I know that you've received a lot of great feedback that we share with our staff, because it's why they're here, and they need to know how people are feeling about, our investors are feeling about the work that we do. And we love the feedback, because we like the feedback whether it's something that we can work on or constructive or positive. So either way, we'll always go back and address it and thank people for it, or make changes, as you've said earlier, in relation to giving the investors what they're after. Thanks, Dave. Stacey, it's been a huge year, so tell us all about the wonderful things that have been happening around here over the last 12 months.
Well, it has been a really big year. So the first part of the year, we really concentrated on consolidating the portfolio, making sure that we had done a deep dive end-to-end on every asset, all the systems, all the processes. We launched the new brand, Quanta, which was in May, which has been really well received.
It feels almost like Quanta, it not that it rolls off the tongue, but it's certainly in the marketplace when you talk about it now, particularly in Brisbane, it seems to have taken really well. I don't know, a lot of people in the street, when you say you're a Quanta, or they say, I see Quanta doing different things, I'm surprised how quickly it was a good choice in the end, I think. Yeah,
I agree. We had our first transaction under the new brand, which was the asset at Yamanto in the multi-sector fund that was settled in July. And we've done a lot of work on a more of a personal basis with the investors. So we've been doing more intimate lunches mostly. We've had a few in the office here. We've been up and down the coast. We've been to Melbourne, Sydney, and made sure that investors have had really good access to us to ask the questions that that they may not have wanted to ask in a more open setting, and made sure that we're really honest and transparent with them, and that's been really well received.
Yeah, even I know Dave Carpenter, our head of investor relations, he's had a number of investors even in the office just to see our operation and set up, and that's been really positive as well. And you can tell even from the amount of phone calls. I mean, even I've been on the phone quite a bit, and when you finally meet those people in person, you definitely cement relationships, and their support's been phenomenal for us over the last 3 transactions. It's been nice both ways, I hope. I think that's the feeling.
Yeah, it really has. While we're very much a property business, that's the product essentially that we're selling. One thing that I've said, and I don't want to just repeat it for the sake of becoming robotic, but our business, it's every bit as important that we are focused on customer service as it is the properties, because we can't do one without the other, and the customers, of course, being our investors. So, if we're not servicing them well, we don't get the support to do the rest of our jobs. So making sure that both of those go hand in hand and that we're really servicing our investors well is extremely important to us, and it's been really satisfying to see the support and the feedback we're getting.
Absolutely. What about you, Chris? Where do you think the interest lies most with the investors at the moment? I know we're doing close-ended funds, and we know that's something that they seem to be taking to really well, and Stacey's been behind driving that. So there's been various types of transactions that are all different through the last 3. So what do you think we need to offer to really keep our investors coming back for more?
Well, the fundamentals always apply, that you get a good risk-adjusted return, but we have seen over the last 6 months that investors particularly like the value-add style of where there's a good underlying distribution with a strong possibility of capital gain. So that's what we're really focusing on, and we think this is an appropriate market to do that because you've got strong occupier fundamentals in that leasing markets are very strong, probably buying assets at considerably lower than you would have been able to 12 or 18 months ago, and our outlook with the types of funds that we're setting up now, which are single asset closed-ended funds with an investment horizon of about 5 years, should be time to get capital growth through those assets, and also there may be some asset initiatives that drive the capital growth as well.
So Launceston, we circled back on it. We paid 13.5. I think originally the vendor was looking for somewhere between 17 and 20. Do you think that we're going to find more opportunity? Do you think? I guess the question is, do you think sellers now are being more realistic with their pricing? Because there was this period, it felt like, for 6 months where they weren't really. They were living in sort of 12 months ago and didn't want to let go of that pricing. But as we saw with Launceston, we were able to do a very good deal there. Do you think we're going to see more opportunity and that the sellers are going to sort of meet the market?
Yeah, I think more so in 2023 than 2022. 2022, there were some vendors not really in touch with where the true value of their assets lay, and but we have tried to be price setters, not price takers, in all of those discussions. So we're finding that there is a bit more of a meeting of the mind. I still think there's another valuation cycle to go through before book values get to where they really need to be to allow parties to transact. But we're getting closer and closer.
That's a wrap for our Quantacast for 2022, and we look forward to bringing another one early in the new year, and hopefully we've got some other great investments. We appreciate all the support from our investors, and have a great year.